Today, we are analyzing the economic and financial moves that many people in the 90s used to become billionaires. And trust me, these are stories that aren't just interesting, they're packed with lessons that you can apply to your life and career. Now, I know what some of you are thinking. You might be saying, yeah, but those guys had it easier. They hit it big in the 90s when the internet was new and the economy was booming. But here's the thing. While the opportunities might have been different, the mindset, the strategies, and the sheer grit they applied to achieve this is still timeless. So let's start by talking about a guy who's become synonymous with smart, aggressive entrepreneurship. Mark Cuban. Principle 1, understanding where the economy is heading. So let's start with someone who's practically become a household name, Mark Cuban. You might know him as the owner of the Dallas Mavericks or a star on Shark Tank, but let's rewind to the 90s when Cuban was just getting started. What was the key to Cuban's success? Understanding the economy and anticipating a crash in his own industry. Here's the details. In 1999, Cuban and his business partner Tom Wagner decided to sell their online streaming company Broadcast.com to internet giant Yahoo. The firm was acquired for $5.7 billion, and since Cuban held roughly 1/3 of the company, he was instantly a billionaire. There was only one problem though. Yahoo had not paid Cuban and Wagner in cash. Instead, the deal involved Yahoo stock, which was surging while the mania surrounding tech companies grew. See, at this time, the stock market was in the midst of something that would later be described as a tech bubble. This tech bubble was something that companies with any involvement in the tech sector, be it a website or even just a mentioning of a website, experienced significantly higher valuations. At that time, Mark Cuban was spooked by the valuations of tech companies, which he felt were way too high. He predicted the bubble would burst at some point and decided to take steps to protect his payout. Cuban did what is called a hedge. He sold calls, bought puts, and essentially protected his own stock through options trading. Now, I'm not going to get into hedging and options trading in this video, but if you'd like to learn more about hedging and options trading, a link to a video explaining it can be found in the description below. Now, without diving too much into technicalities, Cuban's trade is known as the collar in the investment industry. By selling calls, an investor essentially gives up the upside in a stock beyond a certain point. And by buying puts, they can place a limit on their losses if the stock drops. In other words, Cuban effectively locked in the value of his Yahoo stock at the time. 6 weeks later, the market crashed. Cuban's story is a testament to his ability to understand the economy and making investments accordingly. Had he not done this, according to Cuban himself, his wealth would have reportedly been a fraction of what it is today. And what Cuban did is often considered to be one of the top 10 trades in the history of Wall Street. Now, think about this for a moment. What bubbles are blowing up right now that many people have been ignoring? Hold on to that thought because we're about to dive into another story of seizing the moment, but this one involves a slightly different strategy. Principle 2, combining new technology in a changing regulatory atmosphere. Some billionaires in the 90s made their fortunes by understanding and exploiting opportunities in the real estate and finance sectors, particularly as deregulation and economic shifts created new opportunities. So here's the story of Dan Gilbert. Dan Gilbert is the founder of Quicken Loans, and Gilbert became a billionaire by revolutionizing the mortgage industry. In the 90s, he saw an opportunity to streamline and modernize the mortgage lending process by utilizing technology. He focused on making mortgage applications easier and faster, eventually creating an online platform that allowed consumers to apply for home loans directly from their computers. This was a novel idea at the time, as the mortgage process was traditionally done on paper and was very intensive and slow. Gilbert's Quicken Loans company grew rapidly, capitalizing on the tech boom and the housing market's expansion in the late 1990s and the early 2000s. But by positioning himself as a disruptor in a traditionally conservative industry, Gilbert amassed a significant fortune. He later sold a stake in the company to Intuit in 1999 for $532 million, only to buy it back a few years later. Principle 3, identifying the most disruptive technologies of the future. Here's the story of Peter Thiel, who's the co-founder of PayPal in 1998, as well as one of the early investors in Facebook in 2004. In 1998, recognizing the need for a secure, easy-to-use payment system for the ever-growing e-commerce market, Thiel and PayPal quickly became the dominant player in online payments, and they were eventually sold to eBay in 2002 for $1.5 billion. Obviously, Thiel struck gold with the founding of PayPal, but in 2004, Thiel struck gold a second time, this time when making an early investment into Facebook. Now, this company was still in its infancy. Thiel purchased a 10% stake in Facebook for $500,000. This turned out to be one of the most successful early tech investments ever. Overall, there are several lessons that can be learned from Thiel's eye for successful disruptors in the industry. Thiel was successful at identifying and investing early in disruptive technologies and platforms that would become an integral part of the internet economy. This leads us to principle 4, embracing risk when the odds are in your favor. Now, let's talk about one of the most influential and perhaps controversial billionaires of the 1990s, George Soros. The story behind Soros is he bounced around Wall Street for over a decade before launching the Soros Fund Management and coining his classic theory of reflexivity in markets. Reflexivity states that markets move not on economic fundamentals, but on the flawed ideas of human participants. Fallible participants create feedback loops, which is why the boom and bust cycles are often more volatile than economic literature suggests. Soros would use this thesis significantly when placing his bet against the British pound sterling in 1992. Essentially, what Soros did was he made a calculated bet through options trading that the pound was overvalued and couldn't sustain its position in the European exchange rate mechanism. Without diving too deep into the specifics of the trade, Soros made a risky financial bet that the pound would fall in value. When the pound fell, Soros reportedly made over $1 billion in a single day. But here's what's really important. Soros wasn't just gambling. His bet was based on deep analysis and understanding of global economics. He knew the risks, but he also understood the potential rewards. This story isn't about taking wild risks. It's about knowing when to strike. It's a reminder that sometimes to achieve extraordinary success, you have to be willing to take extraordinary risks, but only when you've done your homework. Then there's principle 5, understanding the power of networking effects. At this time in the 1990s, Bill Gates had already established himself as a billionaire. But it was during this decade that Microsoft, his company, solidified its dominance in the software industry. Gates' strategy of licensing Microsoft's operating system called Windows to a wide range of PC manufacturers, rather than limiting it to one brand, allowed the company to become the standard in personal computing. Bill Gates understood the power of network effects. By making Windows the default operating system for PCs, Gates ensured that every software developer would write programs for Windows first, creating a virtuous cycle that made it increasingly difficult for competitors to gain a foothold. Gates also secured deals that made his software indispensable. Think back to how the Internet Explorer was bundled with Windows. This strategy of market dominance turned Microsoft into a tech giant and secured Gates' place at the top. Many lessons can be learned from Gates' success. Among them, don't just think about the product you're offering today. Think about the ecosystem you can create around it. Control the platform and you control the market. Principle 6, work to dominate one market at scale and then advance on to others. Then there's Jeff Bezos, the founder of Amazon. Now it's hard to imagine a world without Amazon, right? But in the early 1990s, Bezos was just a guy with a vision. He was working on Wall Street analyzing markets. But here's where it gets interesting. Bezos took a massive risk. He left his stable job and started selling books online. But it wasn't just about books. Bezos understood the principle of scalability. He knew that if he could dominate one market online, he could eventually replicate that success with other products. And boy, did he. Bezos reinvested almost every penny Amazon made back into the business, focusing on growth over profits in the short term. Fast forward to today, and Amazon is the go-to marketplace for almost everything. The key takeaway here is the power of a long-term vision and scalability. See, in this case, Bezos wasn't just thinking about what would make him money tomorrow. He was building a foundation for decades of growth. Principle 7, mergers, acquisitions, and consolidation. Now, during the 90s, many billionaires grew their wealth by strategically using mergers and acquisitions to consolidate industries, reduce competition, and expand market share. Enter Larry Ellison, the co-founder of Oracle. Ellison became one of the wealthiest individuals in the world by building Oracle into a dominant force in the enterprise software market. He did this by pursuing an aggressive strategy of acquiring competitors and complementary technologies. This allowed Oracle to rapidly expand its product offerings and customer base. By acquiring companies that develop software for various business functions, Oracle was able to offer a comprehensive suite of enterprise solutions, making it a one-stop shop for large corporations. See, this strategy not only increased Oracle's market share, but also solidified its position as the leader in the software industry. Principle 8, identifying the high growth sectors of the era. So some billionaires accumulated wealth by identifying and investing early in high growth sectors such as telecommunications, biotechnology, and the internet. Here's the story of Paul Allen, who was the co-founder of Microsoft. See, not only did Allen earn his money through Microsoft, he invested in a wide range of industries during the 90s that were up and coming, which at that time were cable television, sports teams, and internet startups. His strategy was to identify high-growth sectors and invest in them early using the wealth he had accumulated through Microsoft. One of his most notable investments was in Charter Communications, a cable company that expanded rapidly during the 90s as demand for cable TV and internet services grew. By diversifying his investments across emerging industries, Allen was able to grow his wealth significantly beyond his initial Microsoft fortune. Principle 9. Anticipating the impacts of global developments on the economy. Now, the 1990s saw the acceleration of globalization. Because of this, some billionaires capitalized on the opening of global markets to expand their businesses internationally. Li Ka-shing, a Hong Kong-based billionaire, expanded his business empire significantly during the 90s by investing in infrastructure and telecommunications projects around the world. Li recognized the opportunities presented by the opening of global markets and used his wealth to acquire assets in Europe, Asia, and North America. His company, Hutchinson Whampoa, became a major player in the global telecommunications industry by acquiring licenses and infrastructure in the newly deregulated markets. Li's ability to identify and capitalize on global trends made him one of the richest men in Asia. Principle 10. Thinking long-term. Sam Walton. And here's the final piece of the puzzle, a principle that ties everything together. The power of patience and long-term thinking. You see, not all the billionaires of the 90s made quick moves for immediate gains. Many played the long game. They understood that real wealth was built over time through smart investments, strategic growth, and a relentless focus on the future. One of the most powerful examples of this is Sam Walton, the founder of Walmart. Walton didn't just create a retail chain, he built a dynasty. His strategy? Patience. He expanded slowly and methodically, focusing on rural areas that other retailers ignored. By the time the competition realized what he was doing, Walmart had already established itself as the dominant force in retail. Walton's commitment to low prices, efficient operations, and long-term growth paid off in spades, making Walmart the largest retailer in the world. So, what's the key takeaway for you? Success isn't just about making the right moves today. It's about having the vision and patience to let those moves pay off in the future. Now, before we wrap up, I want you to think about this. What moves can be made today that will position you for success tomorrow? And what is the current economic landscape like? And how do you anticipate it changing in the future? If you found value in today's discussion, give this video a thumbs up and share it with someone who's ready to take their game to the next level. And make sure you're subscribed so you don't miss any of our future insights. Additionally, did you know that according to numerous studies, the most common degree amongst billionaires and the ultra-wealthy millionaires is a degree in economics or an economics-related field like business finance? Numerous studies have confirmed this, and no degree comes even close. The reason for this is simple, because economics is like an operating system for your success. If you enjoyed this lesson and would like a customized education on economics to meet your own goals, join my class. It's only $9.99 a month. The link to it can be found in the description below, and the results have been truly life-changing. So until next time, keep pushing forward, keep learning, and keep making smart moves. We're in this together. Your success is my success, and we're just getting started. Thanks again.